What is a make-whole call? Have you ever wondered how bondholders are compensated when a bond is called early? Today, we will talk about a special feature called a make-whole call. This feature is important for those managing retirement, bond portfolios, and considering interest rate risk in retirement planning. A make-whole call allows the issuer of a bond to repay it early, before the scheduled maturity date. But here's the catch. The issuer must pay a lump sum to bondholders. This amount is designed to fairly compensate them for the early redemption. The lump sum is calculated based on the net present value of the remaining interest payments and the principal that bondholders would have received if the bond had not been called early. Unlike traditional call options, where the issuer can redeem bonds at a predetermined price, a make-whole call requires a premium. This premium is determined by discounting the bond's remaining cash flows. The discount rate is based on a benchmark treasury yield plus a small spread. This ensures that bondholders are compensated fairly for the value they lose by not holding the bond until maturity. In the context of retirement planning, make-whole calls play a significant role. They help reduce the issuer's interest rate risk while also protecting investors from reinvestment risk. Reinvestment risk occurs when bondholders receive their principal sooner than expected and must reinvest it at potentially lower interest rates. The make-whole call premium serves as compensation for this risk, making these bonds more secure for retirees who relying on steady income from their investments. For retirees, bonds with make-whole call provisions offer a balanced approach. Issuers can refinance their debt if interest rates drop, but investors are protected from losing out on expected interest income without fair compensation. However, it is essential to note that these provisions can limit the upside for bondholders if interest rates fall. The issuer is less likely to call the bond unless they are willing to pay the premium, which can be costly. In summary, a make-whole call is a feature that allows early redemption of bonds while requiring the issuer to pay a calculated premium to protect investors. This is particularly relevant in retirement bond portfolios, where managing income stability and interest rate risk is vital. Understanding this feature can help retirees make informed decisions about their bond investments.